Welcome to my channel. I'm the cover call guy, and this is my journey to creating a $120,000 per year passive income portfolio. My portfolio currently yields about $70,000 a year, just about $6,000 a month. I will be strictly using cover call ETFs to reach my goal. And before I reach my goal, leave me a comment. Let me know what's possible stocks I might be missing. I'm open-minded to a lot of new suggestions. I read all of it and I do my research on all of it. So please leave it, and I will read all the comments to the best of my ability. Legal disclaimer before we start. This content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risks, including loss of principal. Always do your own research and consult a licensed professional before making financial decisions. I'm just some random idiot you found online, and I could be completely wrong. All right, today's just covers a little different with a nice Thanksgiving feel to it. So today's topic is gonna be a spicy one. It's gonna be a good one. This was inspired by a conversation I had with a friend who was trying to get into income investing, and he was just saying how he wants to look for stocks that pay him every single day, like a stock that pays Monday, Tuesday, Wednesday, Thursday, Friday, and every week. And that just gave me an idea, right? I was like, oh, why would you want that? Like, he's like, well, I want the paycheck. It's like a paycheck. It's like a weekly paycheck, because right now he gets paid weekly, and he just thought about it, and I thought about it. I was like, man, that is a good idea for a video. Thanks for the idea. I'm gonna go ahead and do my research and see what I can find. So today's is gonna be about a daily paycheck ETF strategy. It's gonna be my deep dive analysis of a high frequency income strategy and its associated risk, right? So we want the high frequency paid out every day, every week. So let's get to it. Let's get started. All right, what is the paycheck strategy, right? You, the investor, seek high frequency cash flow like a 9-to-5 paycheck. That you then buy a basket of ETFs. Then you purchase funds with your staggered distribution dates. Then the staggered payouts you receive on different days or week. And then this create a stimulus looking stream of cash like an actual simulated paycheck, as if you were working a job. Take a good look, guys. This is what I came up with. This is the daily portfolio, right? So each of these stocks pay weekly on these days, right? So we have Monday. I only could find these selected stocks. We have Tuesday and all of these stocks that I could find. We have Wednesday, Thursday, and Friday. So these pay on these days weekly. These are all weekly stocks. So guys, I'm not gonna go through all of it. I would probably be burnt out if I name them all. So guys, I'm gonna leave this for you guys for a few extra seconds. Pause the video, go check them out. If you can't see it, if there's an issue with my screen, let me know and be like, hey, I can't see the Friday or the Tuesday. Can you give me the entire list? And I will give you the entire list. I have no issues with that. Just let me know. Leave a comment. So this slide reflects the provided structure, portfolio structure. The actual payout schedule is analyzed in a subsequent slide. So again, fact check me on these dates because that's what I think they pay out on. I think I try to find the X date and the pay date. So as of right now, Monday I couldn't find much more of Monday. I don't think a lot of ETFs pay on that Monday, but there was a whole bunch paying Tuesday, Wednesday, Thursday, and Friday. So once again, these pay on these days, and I believe all of these stocks pay weekly. So you're getting paid weekly on these intended days. All right, so who's behind the funds, right? So behind all of these funds are from YieldMax, Roundhill and GraniteShares ETF OPPS, Ops, I don't know how to pronounce that. I just know it's a big one. It's from Granite. So let's go over YieldMax, right? YieldMax, one of the primary issuers. They use synthetic cover calls, which is options on single stocks. Does not own the stock. They don't own the underlying, right? Their strategy is synthetic cover calls, and they have a key risk of 95% of return of capital, which could be very eroding for the NAV. Then we have Roundhill. Roundhill, a lot of their ETF uses leverage of 1.2x, and swap agreements to track weekly returns. This is a tactical trading vehicle, not a cover call fund. So please don't get that mixed up, right? Their strategy is using 1.2x weekly leverage, which are swaps. The key risk is that, well, is leverage, right? The counterparty default. So what comes after leverage? Liquidation. So you have to be very careful with that. Then we have Granite, which offer, quote unquote, a daily payout, such as TSII or Yield Boost TSYY. These are also high risk synthetic single stock strategy. The strategy is synthetic cover calls, and the key risk is single stock and NAV erosion. All right, the issuer deep dive on YieldMax, right? So YieldMax, that's their name, that's their company. They hold over 50 ETFs, I believe. I could please fact check me on that. That's what the number I could find. The issuer is Title Financial Group. CEO is Guillermo Trias. The sub-advisor is Zega Financial. And for the most part, their expense is 0.99 to 1.28. Fact check me on that. Their expense was kind of confusing to find, and I would just find a lot of expense ratios from them, so I didn't really know the exact. I just looked at their YieldMax prospective, and that's what I could find. So that's what I put. All right, what is their perspective, right? What is their goal? What is their main objective and how they achieve it? Their strategy and risk behind this. Strategy is use synthetic cover calls. The fund does not invest directly in the stock. It uses options to replicate the risk and reward, and they also hold treasuries as collateral. All right, that's the key risk behind these ETFs from YieldMax is that it's a single issuer risk. It is non-diversified. It capped upside and has phone downside, right? And the biggest one is NAV erosion risk, right? Their prospectus especially warn that repetitive distribution significantly erode the price. All right, then deep dive on Roundhill and GraniteShares. All right, so issuer 2, Roundhill. Their strategy, which is very critical, that this portfolio mixes two different Roundhill strategy. One is the cover call, such as MAGY, pays weekly on the Monday. And then the second is that some of their ETFs are leveraged at 1.2 and uses swap, such as TSOY, WPay, which pays weekly and on a Wednesday. These are not cover call funds, so understand that they are not cover call funds. All right, their key risk is that they use leverage. They have the swap has a counterparty risk, and it is non-diversified. Then the last one, issue 3, is GraniteShares. The strategy is yield boost ETFs, such as TSYY. It uses a synthetic cover call strategy, very similar to YieldMax. It pays weekly and typically on a Tuesday. TSYY has a very high advertised yield of 172% plus, indicating a very high return of capital and very high chance of capital destructive model. Their key risk, single issuer stock, fully capped upside, fully participate downside, and has NAV erosion. All right, the mechanic plausibility, right? The stated goal, if we were trying to go for it, right? This is just an example. On the Monday, we would have MAGY. On a Tuesday, we have TSYY. On the Wednesday, we have WPay. I think Wednesday might also pay on a Tuesday, so we have to double check on that. This is just a list put together that I've just selected. This is not a recommendation of stocks. This is just an example, right? So if you want to get paid on a Monday, MAGY, Tuesday, TSYY, Wednesday, WPay, Thursday, Chippy, and Friday, Tesla Y. This structure assumes each fund pays on a different day, right? So make sure they actually announce it and on the X day, so then you can know when to get paid. That is why you can possibly have 2 to 3 stocks on a Monday, 2 to 3 stocks on a Tuesday, and so on and so forth. That way, if it ever switches or rotates every other week, you still get that nice payout. The multi-year issue reality, right? A 5-day schedule is plausible by mixing issuers, but this creates a portfolio of clashing high-risk strategies, right? So you have a mix of Roundhill, GraniteShares, and YieldMax. The daily payout, a fact check, right? So I try to fact check if it actually does pay out that day, and it looks like MAGY always, almost so far, has been paying on a Monday. TSYY has been paying on Tuesday. WPay, TSLY has been paying on Wednesday. And then Chippy and all the other stocks, they kind of flip-flop sometimes. So I left those two blank because they sometimes pay on that Thursday, sometimes they pay that Friday, sometimes they pay that Friday, sometimes they don't, sometimes they switch back to Thursday. All right, financial flaw, part 1, total return. So this is the issue I came up with when I was researching these stocks. All right, what is total return? A high yield is not profit. Total return is the only metric that matters. It is the full story of an investment's performance. If this number is negative, the investment is losing money, no matter how high the paycheck is. It's that simple. You look at total return. Total return equal distribution plus price change. So an example of NAV decay, you have a 50 plus yield, but the price of your stock dropped by 60%, you have a negative total return. You lost money. No matter what the payout of how much you collected, you lost money. All right, financial flaw part 2, high return of capital payers, right? So we have from Tesla, from Nvidia, Amazon, Coinbase, Apple, Microsoft, these high yield ETFs. A lot of them are ultra high return of capital, which could signal NAV erosion. So a lot of them actually pay out too much than they actually bring in. Group 1 payouts, right? So this is I guess a smarter pick. This is what I put together based on my research. Again, please fact check me. These are still new to me. I just done the deep research today, so my deep dive may be a little off. You can go ahead and fact check me. I'd love to correct my videos or for the future videos. So if you guys are already buying these stocks, let me know when they pay out, because it was a bit hard to find some information. All right, we have Chippy. It holds 15 to 30 semi stocks plus sells calls. The return of capital, I think I think it's 0% because it might be too new. Quality, I'm gonna put it as excellent. Real income. Then the next we got QDTY, which is synthetic 0-day expiration calls on the Nasdaq 100. I would say that's good. It's diversified. Then we have RDTY, which is synthetic 0-day expiration on Russell 200. So far, I would put that as good, diversified. Then we start getting into the OK, poor, and poor, which is SDTY, YieldMax, and OT. And it may not all be bad based on return on capital. Again, you want to see return of capital, but no price decay, right? When you start having price decay and it's consistent, then you know there's an issue there. All right, my case study, total return failure as case study 1. When you buy these stocks, such as GOOY versus Google, you can see here Google went up plus 53% in 2023 versus YieldMax ETF GOOY, right? Total return is no good. And then case study 2, buying FBYY versus Medicine's Inception, right? It missed 30% of the upside. You're still positive, you're still good, but you have to understand that these are not going to ever catch up to growth stocks. So we're here for the income. And then this is just a illustrative risk versus yield. I put top tier as an example there to have comparison. Right, we have JIPY at about 15% yield, high risk TSLY at 60% yield, and then extreme risk would be like TSII at 90% yield, right? The top tier funds have low risk and unsustainable yield. The daily/weekly funds have extreme risk to match their extreme but artificial yield. So that's something to think about. That's something to be like, okay, these might be for you if you're like an active trader and you check it every single day. Like you're at work 8 hours a day when the market opens, that might be for you. These are not all bad. It just depends your risk tolerance, your education, and how well you know yourself and the funds. So this is not a video about bashing any of these stocks. It's just you have to be knowledgeable and educate yourself before getting into it. You have to know the risk, right? Otherwise, you are gonna get completely chewed up and spit out. These high yield stocks will do that to you. All right, building the daily portfolio, right? This is what I kind of gather and put together. If I were to do a daily/weekly payout, on the Monday, I would choose the MAGY stock. My bull case for it is because it's diversified across Mag 7. Diversify here, but it is concentrated in the Mag 7, right? The thesis is that the extreme growth of the underlying stock, Nvidia, Meta, Microsoft, etc., of the Mag 7 will offset the NAV erosion from synthetic strategy. Then we got Tuesday at TSYY. The risk here is as a single synthetic stock with a over 170% yield, indicating a high return on capital. It's capital destructive model, so it's that one I might have to flip in and out, right? I have to switch, sell in, sell out if it goes up. That's I have to keep an eye on. Then we got Wednesday at WPay, right? This is my risk is that is a 1.2x leverage. This is a tactical swap fund for traders, not a long-term income investor. So if I wanted to be a active trader to get into a weekly pay, I would have to check it every single day from 9:30 to 4 p.m. Eastern time. Then we got Thursday with a Chippy, CHPY. I would put this as the quality pick out of the bunch, right? I would say the best structured fund in the list, holds real stock, is diversified, and so far has zero return of capital, which is, I would say, it's real income because they actually make profit. Then we got Friday for Tesla, right? The risk is that is 98% return of capital on a synthetic fund. Its Paycheck is return of investors' own capital. I would like for it to see a little bit smaller rock, almost 100% rock, and with a falling a NAV, right? I think when did this come out? Let me see. When did TSLY I think came out 2022. I had to fact check on that. 2022 or 2023. And since then, I think it went down like goddamn like 85%. So you are literally just being paid out your own money plus, and you actually lose out more because you pay an expense ratio, right? So just don't think, oh, I'm at least getting my money back. No, you're actually not. So not only are you losing capital appreciation, you actually have to pay an expense ratio. And since it's a 98% rock, that means you have to pay taxes on that 2%. So you're not gaining anything. You actually lose out. So I mean, I chose this. I guess I could have swapped it for something else, but I guess this is just an example of a list. It was hard for me to really pick. If anything, I would have had like at least 2 to 3 stocks here, 2 to 3 stock Tuesday, 2 to 3 stock Wednesday, Thursday, Friday. So this is just an example here, guys. This is not my advice to give you guys. This is just built up and be like, all right, these are the best stocks I kind of put together so far. Okay, this would be my superior top tier monthly alternatives, right? So if the weekly really doesn't work out, these would be my monthly pick. Now, yes, most of the monthly pays on the same week as every other monthly. So like JEPI pays on first week of the month. JEPQ pays first week of first week of the month. GPIX pays the first week of the month. SPY pays the last week, and then Divo pays the last week. Again, these are some of the, in my opinion, superior top tier monthly alternatives. If you think that the weekly is not really, you wouldn't go all in, you might have like superior, these, you might hold the monthly alternatives and trickle in some weekly. That's what I'm doing right now. I'm building up my monthly cores, and then maybe have like 2, maybe 3 weekly ETFs. That's what I'm currently, my strategy and my income vision is. All right, my exclusive summary. All right, this is my breakdown of what I've come to so far. I think there's a mechanical possibility that a 5-day payout is technically possible, but requires mixing multiple high risk issuers, right? You have to mix the YieldMax, Roundhill, and GraniteShares with clashing dangerous strategies. All right, there's a lot of product misidentification. The portfolio dangerously mixes synthetic cover calls with leverage and high return of capital. There's a lot of financial flaw here. The paycheck is just an illusion. As I can find right now, data confirms that what it distributes are 95 to 99% return of capital. The fund returning the investor's own principal back, causing long-term share price decay. What is my verdict? What is the cover guy's verdict? Well, my verdict is this, that the daily paycheck goal is a technical trap as of now. From what we can see, right? A lot of them are new. If we give it a year or maybe 2 years, we'll see how they play out. But as you can see, like Tesla, TSYL, I think, is down like 80-85%, and it had like about a 3-year track record. So I'm not too optimistic on a lot of these weekly ETFs. Maybe 1 or 2 of them, maybe 3, but that's it. It is a plausible on the calendar. But it forces an investor to build a portfolio based on payout date rather than investment quality, right? The strategy dangerously mixes issuers and strategies. It combines YieldMax, synthetic return of capital with leverage and swaps. They are not comparable and should not be used in the same long-term portfolio. The paycheck from the core funds is not income. It is a 95 to 99% return of capital, which is simply the fund returning the investor's own principal to them. My verdict, this portfolio is not reliable for long-term paycheck. It is a high-risk, capital destructive, tactical trading strategy. Investors like myself seeking sustainable income are far better served by, I would quote unquote, my top tier monthly payers. Examples are JEPI, SPY, Divo, that prioritize real sustainable income over a high frequency artificial yield. And that is my conclusion, guys. I hope you like it. I hope you guys enjoyed it. Let me know if you guys enjoyed it, or if you guys do own weekly ETFs. Let me know how it's going. Perhaps I'm wrong. Again, I'm going based off the historical data. A lot of these are new. Yes, I understand that. So please don't like go too crazy on the comments telling me that I'm completely wrong and this works. We have to have a longer data on if it actually can survive a little bit of a downside, prolonged bear market. That would be the real test. Right now, disclosure, I am nibbling on one weekly ETF, which is MAGY, MAGY. So far, I really love it. I have high conviction in the MAG 7, and it's one of the biggest reasons why. I think it will do well. I think it will perform well even when the MAG 7 takes a downturn. I don't think the MAG 7 is going anywhere. What is it? 5 out of the 7 is like, or 6 out of the 7 is all worth $1 trillion, or 7 out of 7. So I have very high conviction in these stocks. I just had to do a quick fact check. As of November 10th, all MAG 7 companies are all worth all of them are above $1 trillion. So that is one of my biggest convictions too, because these are absolutely amazing companies. So yeah, I really believe that they will perform very well long term. So thanks for watching, guys. I hope you guys liked the video. Again, no hate on any of these ETFs and funds. I mean, it just doesn't fit my needs right now. I only own one ETF out of the bunch, which is MAGY. And I will be building that position up to pay me at least $1,000 a week. Full disclosure. And stay tuned, guys. Thank you for watching. I appreciate it.